So Ankit, we can take some of the questions now, if possible.
So we have a few questions. Let me start. So Jacob Matthew saying, aren't ARCs not able to acquire NPAs? If so, how can they acquire SMAs?
Typically can acquire. ARCs definitely are made to acquire NPAs only. Rather, SMA 0, SMA 1 and SMA 2 are additional assets that they can acquire over and above the NPAs.
Yes. Good morning, everyone, and welcome back to our weekly webinar series. At episode number 164, we will continue the journey of understanding everything about ARCs. Over to Anil sir.
Thank you, Ankit. Thank you very much. And namaste, good morning to the participants. First of all, let me share with you a little difficulty which Sanjay Tibrewal, the Managing Director and CEO of Phoenix ARC Private Limited, who has a lot of practical experience about ARCs. He was likely to join this episode as an expert who would guide us on various practical questions. But in the morning, he developed an medical emergency and he had to go to a doctor. And even presently also that he is waiting at the at place of a doctor. So nothing serious, but then it required an urgent attention of a doctor. So he could not participate, or he will not be able to participate in this episode. However, we have invited him for the next episode, so that will be attended by him. In fact, this the series on ARC, in fact, we would try our best to bring various experts on ARCs so that our audience gets a complete one, that we actually have already deliberated on the SARFAESI law, specifically the part dealing with the asset reconstruction companies. Secondly, we are starting from today the guidelines, master guidelines from Reserve Bank of India regulating ARCs in India, and also on various aspects. Today, we would be discussing the RBI guidelines, and then coming to the next episode, which would be the episode number 165. We would be taking a break on this ARC series, because the regulations have been notified by IBBI, and as per the expectations of our audience, the regulations needs to be attended. So again, after this 165th episode, we would be from again 166, we would continue the ARC series, and that will start from the rest part of the RBI guidelines, and then the practical aspects, which will be answered by various other experts in the ARC segment. So we today we are saying that although we announced the participation of Sanjay Tibrewala, the Managing Director and CEO of Phoenix ARC, but then he could not attend this episode and his expert advice was not available today. However, he would be available in the subsequent episodes. So this is where we actually, the part one that we have already done. In fact, in two parts, we have done the legal framework and how the ARCs were in fact evolved in India. And from today, we would be, although it's a part 3, because this the subject is a little lengthier, so we are trying to cover as much as possible. And today is part 3 of the ARC learning series. So we would be, in fact, focusing on RBI directions, governance by RBI, and how it is linked to the SARFAESI law. Because see, the RBI has got the powers only through this SARFAESI law. So this is the master directions. The master directions this RBI has issued, and that was in 2024, which was consolidating all the earlier directions issued by RBI from time to time. So these directions, in fact, it outlines the comprehensive regulatory framework for asset reconstruction companies operating in India, and it also provides the details of registration requirement, minimum net owned fund stipulations, and the permitted activities and other guidelines for asset acquisition and reconstruction. So this is where everything regarding the registration and then acquisition and reconstruction and restructuring, that is all that is covered in master guidelines by State Bank of India, by Reserve Bank of India. Now, the Reserve Bank of India in their master directions have covered various prudential regulations, which addresses the prudential regulations, governance standards, accounting policies, disclosure obligations, and reporting requirement for ARCs, which is aiming to ensure their prudent functioning and also protect investor interests. Regarding the various valuation and capital requirement, regarding the valuation of security receipts, regarding capital adequacy, asset qualification, provisioning, and fair practices also are covered in the master directions. And the short title for these directions are Master Directions, Reserve Bank of India, in bracket, Asset Reconstruction Companies Directions 2024. This was effective from the date it was placed on RBI website. So according to our information, it was placed on RBI website on 24th April 2024. Therefore, it is effective from 24th April 2024. That's what is the normal way how the master directions are being applicable. It was mentioned in the master directions also that it is effective date will be the date on which these directions are posted on the portal of RBI. These directions are applicable to all asset reconstruction companies which are existing in India and who are registered under Section 3 of SARFAESI Act, registered with RBI under Section 3 of SARFAESI Act. That is where the these master directions are applicable. There are various definitions given in the master directions. Like in case the Act, that means that whenever we talk about Act, that means the SARFAESI Act, the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002. That's what is the full name, but in short, we call it as SARFAESI Act. Now, then there is another definition, which is change in management. Now, the change in management is defined in the master directions as effecting change by the borrower, at the instance of ARC in the person who has responsibility for whole or substantially whole of the management of the business of the borrower or other relevant personnel. So that means in case the ARC changes the management, means in the person. Changing in the management means the person or persons can be changed by the ARC who has the responsibility in whole or substantially the whole of the management of the ARC. That is what is defined as the change in management. Then change in management doesn't have any link to the change in shareholding. Change in management is only person who actually has the responsibility of management of the business of the ARC, means business of the borrower. It is not something which is ARC, it is the business of the borrower. Because see, as per SARFAESI Act, even the ARC would have the power to change the management of the borrower and also to take control on the management of the borrower. That is also something which is in the powers of ARCs as per SARFAESI Act. Then the definition of date of acquisition. Date of acquisition means acquisition of an asset. When ARC acquires a debt, that means it is acquiring an asset. Because for ARC, acquiring a debt means it is an asset. The date of acquisition means the date on which the financial asset is acquired by ARC, either in its own books or directly in the books of trust. So that means what we are saying, the asset can be acquired directly in the books of the ARC, or it can be acquired in the books of a trust, and that trust must be floated by the ARC. So that is the date of acquisition for all future references. For all future references, that is the date of so this is where we actually try to see, like in case we say that so then we also see, like, then we also say that there are some other definitions, and those definitions are the definition of deposit. So that's very simple. The deposit is defined as defined in the company's acceptance of deposit rules 2014 and under section 73 of the Companies Act 2013. Then there are three kinds of values which are defined by the RBI in the master circulations. The three values are breakup value, earning value, and fair value. Breakup value, earning value, and fair value. Now, let us understand what is breakup value, and then we will understand what is the the use of it. Now, the earning value, which is defined, it means the value of an equity share. Value of an equity share computed by taking the average of profit after tax, PAT, profit after tax, as reduced by preference dividend, and adjusted for extraordinary and non-recurring items for the immediately preceding 3 years, and further divided by the number of equity shares of the investee company and capitalized at the following rate. Now, investee company, whenever under the ARC protocol, under the ARC the ecosystem, whenever we have to calculate earning value of an entity, of a investee company where the asset reconstruction company is investing, then there has to be a calculation of earning value. Now, the earning value is considered to be average PAT of 3 years as reduced by preference dividend and reduced by extraordinary and non-recurring items. And then we have to just capitalize it. So in the case of a manufacturing company, we capitalize it as 8%. In the case of a predominantly trading company, it will be 10%. And in case of any other company, including non-banking financial companies, it will be capitalized at 12%. So if an investee company is a loss-making company, then the earning value shall be taken as a 0. See, in our future discussions, we will actually see what are the use of this definition, which is the earning value. Then we also see this earning value and then the breakup value. Now, the breakup value, as probably it was very simple, equity capital of the investee company and reserves, equity capital plus reserves minus intangible assets and revaluation reserves divided by the equity capital. So this is more or less equivalent to the book value of the investee company, of a company. But according to my understanding, not every intangible asset should be reduced from the breakup value. So the breakup value is almost equivalent to the face value. Earning value is something which the value is coming out of the earning capacity of the company, and the fair value is the mean of the breakup value and the earning value. Mean of the breakup value and earning value, that is what is the fair value. And then we in fact move on to the very, very important definition, that is net owned funds. NOF, net owned funds. In fact, for the purpose of registration of ARC, where we need to have 300 crores of net owned funds, we must know what is the definition of net owned funds. And the net owned fund, as per the master directions of RBI, it actually means the amount arrived at by reducing from owned funds the amount representing. So there are another issue which is used is owned fund. So we will see what is owned fund. So in fact, we can actually go to the owned funds first, because see, this definition of net owned funds, it actually depends upon the definition of owned funds. So first of all, we must understand what is the definition of owned funds. Owned funds definition, owned fund represents the net capital position comprising of paid up equity capital, paid up preference capital, plus free reserves and profit and loss account debit balances. And there are some additions and some reductions which are supposed to be calculated before we arrive at the figure of owned funds of a company, owned funds of an ARC. So the owned funds components like means aggregate of, as I said, preference share capital, equity share capital, free reserve, profit and loss account, and the balance. So then is the reductions. So as reduced by the debit balance in the profit and loss account, miscellaneous expenditure to the extent not written off or adjusted, intangible assets. The book value of intangible assets must be reduced for the purpose of arriving at owned funds. Then we have this provisions. In case the ARC is required to create more provisions, but short provision has been created in the books of account, then whatever is the short provision, that amount of shortage will have to be reduced from owned funds. Also, any income which actually have not accrued as of today, but that income has been recognized in the financial statements of the ARC, that also has to be reduced. And other deductions required on account of items qualified by the auditors, like in case the auditors says that the net worth of the company has been overstated because of this and this reason, then all those reasons, whatever is mentioned in the audit report, that must also be reduced from the owned funds. So this is where we have divided what is owned fund. And when we go back to net owned funds, so when we have calculated owned funds by reducing various items, now the net owned funds are further supposed to be reduced. Net owned funds are further supposed to be reduced with regard to, it has to be reduced by the amount of investment made by the ARC in the shares of its own subsidiary companies. Then investment in the shares of companies in the same group, and 3, investment in same group and all other ARCs. In the same group and all other ARC, that is where is important. And then we have other deductions like the book value of debenture. So that is the equity part of it. In case the ARC has invested in the equity capital of subsidiary companies or companies in the same group or in other ARCs, that has to be reduced from owned funds to calculate net owned funds. That has to be reduced from owned funds to calculate net owned funds. And then further, in case there are investments made by the ARC in some debentures, bonds, outstanding loans and advances made to and deposits with made to the subsidiary companies of the ARC. If in the ARC, first part was touching the equity capital in the ARC. Now we are touching any debenture, bonds or outstanding loans and advances which is given to the subsidiaries of the ARC and the companies in the same management to the extent such amount exceeds 10% of all the owned funds. So in case a company has 350 crores of owned funds, and then that company has invested say up to 10% in the debentures or loans to subsidiary companies or companies in the same group. So that means 350 minus 10%, which actually can be, or it can be 50. So that will be reduced. And then the balance amount will be considered as net owned funds for the purpose of registration of the ARC or for the purpose of continuation of the registration of ARC. That is what is the definition of net owned funds. And we now can see the definition of NPA. Now, the definition of NPA, as per RBI guidelines applicable to all banking institutions and financial institutions, or even NBFCs, those are different as against what we can say for asset reconstruction companies. So what we are saying is the net performing, the non-performing asset definition is different from the definition which we have been reading or we have been implementing in the case of banks and financial institutions. However, for ARCs, the net performing asset is slightly different. One is the post-acquisition default. Post-acquisition default, like once the ARC acquires a debt, after that, in case interest or principal or the installments is overdue for 180 or more days from the later date of the date of the acquisition, or the date of the acquisition, or the due date under the original or the due date under the original contract. So post-acquisition, one is that the interest or principal or installment is overdue for 180 or more days from the date of acquisition. Then is the date of acquisition or due date under the original contract. So whichever is later is very important. So there are two dates. One we have is the interest principal is overdue for 180 days or more from the later of the date of acquisition by the ARC or the date of contract. So in case an NPA as per the original contract is acquired, and 180 days have not passed as such, so therefore the due date can even get shifted. The due date under the original contract can also be shifted. Then is the default under the recovery plan. So whenever there is an acquisition by ARC, the ARC has to give a recovery plan. And if there is an overdue, in case the recovery plan says that this much of money will be paid on this date, and if that date crosses and the money is not paid, overdue for 180 days plus from the due date specified in the formulated recovery plan. So when we take over an assignment as an ARC, there has to be a recovery plan. And once the recovery plan is there, then within 180 days, in case the recovery is not implemented, then it means that this is again considered as NPA. Then there is no plan formulated. In case there is a new acquisition, however, the planning has not been done. The recovery plan has not been made. And if the no recovery plan is made, then overdue on the expiry of the planning period. So the planning period is normally mentioned in the acquisition contract. Planning period, that in how many days the recovery would be possible. So that planning period is mostly there in the acquisition agreement. And in case there is an overdue or the planning period has been expired, then we can say that the planning period has been expired. So the loan actually has converted into NPA. And in case there is no plan formulated, then the overdue on the expiry of the plan, if no recovery plan. So when this planning period, if the planning is supposed to be done in 2 months, and once the planning is done, it's okay. In case the planning is not done, in case the recovery plan is not prepared, then the NPA would be considered. Then that will be considered as NPA. For general receivables, any receivable, any asset of the ARC which is overdue for 180 days in the ARC books, that is also considered as NPA. So therefore, it is actually provided in the law, in the master direction, that the board of directors of an ARC may. The board of directors of an ARC may, on default by the borrower, classify an asset as an NPA even earlier than the period mentioned above. And that can only be done for facilitating enforcement as provided in Section 13, subsection 4, or Section 13 of the SARFAESI Act. So this is what I'm trying to say, is the one that the NPA definition in ARC is different than the banks and financial institution. Number two, the ARC has the option to declare a particular account after acquiring as NPA and take action under SARFAESI law. That is the power which is enjoyed by the ARCs. That the ARCs can actually ARC can use their will to declare a case as NPA only on single default. It is 180 days is not something which is required for categorizing a case as NPA for the SARFAESI. So Ankit, anything that you would like to add here? Or if there is any question, please.
So we have two questions. One question is what are the directions of for assignment of debt to non-ARC by banks, financial institutions, NBFCs, ARCs? I remember reading this up for a particular case, and if I remember correctly, it used to say that the assignment can be done as long as the entire consideration is received promptly. I think that was the. So in that case, it can be assigned to anyone. However, I know that many ARCs have this board approved policy that even if somebody is paying the full consideration, they are not allowing the assignment to happen to a non-NBFC. So they would then want an NBFC which is entitled to do SARFAESI action. So what I'm trying to say is that the board approved policy of that particular bank, ARC, NBFC might be different from the regulation which permits the assignment on these grounds or on this basis. Then Mr. Kedia is asking whether contingent liabilities such as income tax demand under appeal to be reduced for arriving net owned fund. Is there any guideline to reduce contingent liabilities from net owned funds?
No, see, what I understand is the income tax demand, whenever it is raised on an entity, it is not contingent. It is a pure, simple demand. It might be in appeal, but this is not a contingent demand because the assessment order has already been passed. The demand has already been raised.
He's not saying contingent liabilities, it's contingent liability in the books of accounts. So the company has not recognized that liability because the company says it is contingent maybe on the decision of the appellate authority, something like that. That's what he's saying, that is contingent liability which is disclosed in the books of accounts required to be reduced from the net owned fund balance.
No, the contingent liability, when we talk about contingent liability, so my understanding is that the contingent liability is not appearing in the financial statements as liability.
That's how it is.
So yeah. when this liability is not appearing, so any contingent liability has to be reduced. That is not implied. So financial statement says that the net owned funds are say 400, and if there is a demand outstanding from income tax department and the appeals are pending, I don't think that will be considered as the doing a kind of net off for the purpose of, or it is not required to be reduced from the net owned funds or owned funds for the purpose of this RBI master directions.
Then there's a question from Mr. Jacob Matthew. He says, can ARCs lend money?
ARCs lending money is something which is very, very restricted. Although we are covering this, what ARCs can done, we will be coming to those slides. I think we should wait for some time that what ARCs can do, that is something which is also in today's agenda.
Right. So that's about it. I think we move forward.
So when we talk about standard asset, the definition is very clear. Any asset which is not an NPA is a standard asset. Then the due, overdue. Then it is the overdue. The definition of overdue means an amount which remains unpaid beyond the due dates. And then the takeover of management, that is as per section 3 of the SEBI law. Takeover of management means taking over of the responsibility for management of the business of the company, business of the borrower, with or without effecting change in management personnel or the borrower by the ARC. So what we are trying to say is that the ARC has the power to take over the management, and that management can be taken over for the purpose of managing the business of the borrower, and it can be done without effecting change in the management personnel, Rather, the ARC can appoint a boss over them. ARC can appoint consultants which will take over the management of the company. So that is what is the definition of takeover of management. Then coming to the planning period, because we have just seen that the planning is required. Before we acquire, the planning is required. So in case we were saying that the planning, like this planning period definition, therefore is become very important. So the planning period is when we actually a recovery plan we have to make as an ARC, and we have to submit it to the banks, that what is our recovery plan. And based on that recovery plan, the payment is also offered to the banks for handing over the assets. Now, the period, planning period means a period not exceeding 6 months allowed for formulating a plan. So the plan has to be formulated, and that plan is regarding how to recover the default, how to make recovery acquired for the purpose of reconstruction. So the planning period actually is 6 months, which is given to it is given to the ARC in case the planning is not done. In case his planning is not done, I think it is important that we should try to see the planning is something which is if no plan formulated. So in case the planning is required in 6 months, and if no plan is formulated, then it actually will become overdue. Overdue on expiry of the planned period, if no recovery plan is made. So that is linkage between the planning period and the other part which we have just seen, the declaring as NPA. That is where the planning is important, NPA declaration. So then is the next subject, like the registration and related matters. So when we talk about the registration requirement, we see that the legal requirement of the registration is that the every ARC, every prospective, every person who would like to register an ARC under SARFAESI law for obtaining a certificate of registration, and he will have to file an application to Reserve Bank of India, and that Reserve Bank of India will consider the application made by any person. Now, this registration is primarily required. Why it is required? Because this ensures that only regulated and eligible entities operate in this sensitive financial sector. Then the certificate of registration, KOR, certifies that the company complies with RBI prudential and regulatory norms. That is also what is important, because every day the ARC, every day will ARC actually seeking registration is very important, and continuing with the regulatory framework, continuing with the kind of domination of regulator, it will be considered as, because it's being a financial, it's becoming sensitive financial sector, it will be considered as that the company is complying to RBI prudential and regulatory forms. So Ankit, I think a couple of things that you can add here, because in the ARC, the practical part, what kind of questions that you think are coming now?
No, I see that there is another question from Mr. Kedia. Just give me a second. So, Mr. Kedia is saying whether there is any restriction on ICUB agreement with borrower connected person before acquiring assets from the bank. I think we can take it up later. Intercorporate in unstructured borrowing agreement with investor to acquire a particular asset.
No, I will come to that. I will come to that. That is there in the later part of the program.
Yes. So I believe that with respect to the application process, yes, we see that so many ARCs have come into picture, and we see some many very active ARCs that are doing a lot of good work in the system. But at the same time, we do have a process where we used to have many ARCs who simply used to kind of take the assignment and used to kind of allow the promoters to continue working unhindered while the companies were still in stress. So those times I believe are over now. The safeguards that were brought in place for the system to work, I think it's working wonderfully now. We see that so many companies are now being so many lenders or stressed assets are transferred to ARCs, and ARCs are kind of doing a super specialization and transforming those. Even with respect to an RCL IDRCL, 1 lakh, one lakh crores is what is the number, which is the amount of bad debt that NARCL has taken over. Their target was 1,50,000 crores, but they have already done 1 lakh crore. So there's a huge number for them to kind of work on.
I think there are some couple of questions, and some party also raised a hand.
Then we have I think I can allow the raised hand. No, I don't see a raised hand. So then we have, of course, so Vijay is asking whether banks can assign NPAs to individuals or entities such as not ARCs. We did answer that, yes. We did
Yes,
talk
it
about.
can be done, but the only condition is first the payment will be made in full, and then the assignment agreement will be signed. That is the condition. And that will be full payment immediately upfront.
That's about it. I think we can continue.
So we now discuss the application procedure and the permissible activities. When we see the application procedure, actually it is required that every person who actually would like to make an IRC will have to make an application to Reserve Bank of India at their Mumbai office. It is called Department of Regulation, Reserve Bank of India, Mumbai, and RBI may request further documents or clarifications to verify the ARC's compliance norms. Now, after the ARC is registered, what are the permitted activities which the ARC can do? One, once registered, the ARC may engage in the securitization of financial assets. The securitization of financial assets means like considering a bouquet and then participating into that bouquet, that this is what we would like to take over. And then is the ARC may engage in asset reconstruction activities. Asset reconstruction activities, which is kind of upgrading the asset, upgrading the borrower, fetching more value, and like somehow bringing him out of the structure. So these activities must be carried out as per the provisions of SARFAESI and directions issued by the RBI. That is where we actually can see the application procedure and permitted activities. Time limit, which is provided in master guidelines, is the once an ARC is registered and must commence its operations within 6 months. And if it doesn't commence the operations in 6 months, they will also get it insured. And then RBI may allow as to what 12 days. It can allow up to 12 months upon request if valid reasons are furnished. So original time limit is 6 months for kind of commencement of business. and then it can be extended to 12 months further. It can be extended to 12 months further, so that this is along with the valid reasons. Then coming to the exemption from NBFC regulations. So there are regulations there are regulations in RBI Act, and the regulations are 55 IA, 45 IB, and 45 IC. These three sections of the RBI Act says that these four sections would not deal with a kind of delegating to someone. So the bank says that these issues in these cases are huge. So therefore, they would not like to assign it to someone. They will like to fight it, because the value can be anything. Then is the restriction on unregistered entities. No company other than registered ARC can perform ARC-related functions, unless provided under any other law or regulation. Banks or financial institutions performing assets sale under their own regulatory framework. That is where is the so when we talk about we've talked about the registration, and we've talked about the net owned funds. So it's like let us understand that about few years back, this interim target was 200 crore, and ARCs existing as on 11th of October 2022 must have net owned funds of rupees 100 crore. And that is the first target, that is the first trigger, that as on the date like 11th of October 2022, when the net owned funds requirement was 100 crore. So what we are seeing is that the net owned funds requirement was 100 crore as on 31st March 2024. And then it increased to 200 crore, and then it increased to 300 crore. So as on 31st March 2004, the reaching level of 200 crore only. That is the level that 200 crore can be the net owned funds. And thereafter, the another obligation on the ARCs are that their final target is 300 crore, and that is up to March 26. So during this financial years, all the ARCs which are supposed to be staying in the market will definitely have 300 crores of net owned funds, as we defined earlier. Now, let us try even more some of the things. Okay, so let us try one of so in case any ARC is not able to generate funds and not able to create this 300 crores which ARC is supposed to have it, and when this up to 31st March 2026, in case any ARC is not having net owned funds of 300 crore, then RBI can consider this as a non-compliance, and the non-compliant ARCs shall be subject to, or can be subject to, supervisory action, including prohibition on undertaking incremental business till it reaches the required minimum NOF, net owned funds. Required minimum NOF, that is what is required. So up to 31st March 26, every ARC, if they have to continue, will have the net owned funds of 300 crore. And we have seen the definition of net owned funds. It also excludes the investment in equity shares made through subsidiary companies or group companies or associate companies. And also, on the other hand, on the asset side also, if there is anything which is not recoverable, then the net owned funds will be reduced. Any loans or advances or any debentures which are not considered as healthy will also be reduced from non-fund-based facility. ARCs can do the activities as defined in RBI. Now, the ARCs can do those activities like, for example, the ARCs can do the activities like, as per Section 10, ARC can undertake securitization of assets and engage in a reconstruction of financial assets Then is the acquiring NPA. The ARCs can also purchase NPA from financial institution. The ARCs can purchase NPAs from financial institutions, and then they can maximize value recovery from distressed assets. They can maximize, so there will be some planning how to maximize and managing and resolving through enforcement, settlement, or restructuring. They can actually manage and resolve. Now, the ARCs are also permitted to act as resolution applicants under CIRP of any company which is under IBC. The only condition the RBI has imposed on the ARCs, one, that if you want to become a resolution applicant in your ARC name, then you must have a net owned funds of 1,000 crore. Then they must have a board approved policy where the board will decide as a guidance to the staff that what kind of sectors that you are interested, and also the kind of due diligence and internal risk controls. That is the kind of policy that the board of directors of ARC will have to frame to assure that due diligence is done, internal risk controls are activated. It should be a sectoral limit, should also be fixed in the board. And then the type of cases to be pursued also should be mentioned very clearly. So these are the, then post-resolution, what are the obligations of the ARC? Once this resolution is passed, NCLT approves the resolution plan, which is submitted by an ARC. In that case, the ARC must not retain control or significant influence over the resolved entity for more than 1 year. So in case the ARC have acquired an asset and have sold for more than 5 years, that is where the ARC must not retain control on the. You see, if there is any asset which is acquired by ARC in their process of securitization or enforcement of security interest, then they can hold that asset only for the purpose of 5 years, not otherwise. Otherwise, the special approval will be required from RBI to invest in properties. Then is the failure to comply bar with ARC from acting as a resolution applicant or co-applicant in any future CIRP. So the failure to comply all these above requirements will actually make that person, that resolution applicant, as failed. So he will not be entertained in the branch again. That is what I'm thinking. Then the ARCs can also make investments. So there are some limitations on ARC making investments. One, that the ARC can make investment in another ARC also. ARC may invest in another ARC. It can be invested as a sponsor, or it can be also done as a joint venture. Then is the collaborative resolution. So whenever there is a resolution which is being proposed, it has to be a collaborative action between the older banks and the new banks. So that is something which is a problem which is faced by at this moment, because but the ARCs, in fact, want to invest in other ARCs as a sponsor, but then they are saying that the collaborative resolution approaches at times become difficult. And then after the investment in other subsidiary, then we actually have to say investments must comply with RBI's group exposure and cancellation form. Now the ARC can also deploy funds in case they have some funds they can deploy in restructuring of the NPA that the ARC has acquired. And ARC can give fresh funding only in case the money which is being funded is not related to the existing business. It is related to an expansion which is unrelated to the resolution. Therefore, the trading of the ARCs is also not possible. So therefore, the deployment of funds of ARC is restricted to board-approved policies, where the board will decide that where to invest the surplus funds of ARC. It can be invested in government securities, which are low-risk investment in government-backed securities. Then bank deposits, deposit with a scheduled commercial bank. Then mutual fund, like units of in liquid mutual funds. Then high-rated instrument, which is the CA boost with rating 100 as a rating. So now the RBI has further said that it can be invested in the money can be invested in government subsidies and deposit with scheduled commercial banks, SIDBI, NABARD, or any such entity as may be specified by the Reserve Bank of India. So most of these funds are going to SIDBI and NABARD. That is also very clear. Then is the restriction on real estate. ARC cannot invest in land or buildings except for own office use. For own office use, these subject to 10% of the owned funds. Then a settlement after making investment, after acquiring the asset, the ARC can also do settlement or enforcement under SARFAESI law. So that's where we actually have the ARCs taking an action. And deposit prohibition, as I already said, ARC are not permitted to accept deposits, keeping their structure separate from banking or deposit taking NBFCs. Now is the last part, which is the guidelines on asset reconstruction and securitization. Now, when an ARC acquire an asset, first of all, there has to be an acquisition policy, and that policy has to be board approved within 90 days from the certificate of registration. Then is the board approval from the ARC must have a board approved policy specifying norms and procedure for acquisition either on its own funds or in the books of directory or the trust funds. Then the asset type also has to be very clear, and types of the financial asset that is required to be taken over after the board approval. Valuation method, it has to be implemented. Resolution plans. Now, in case there is any resolution plan and the formulation of plans for the realization, that's okay. But for any realization plan, the ARC must work, and then it must be a due diligence time. Minimum 2 weeks should be taken by the ARC for doing due diligence, and that is something which is very important. The valuation standard has to be used. The valuation has to be at arm's length, and it should also consider the value of collateral securities and legal risk, which is again pending. The due diligence, minimum 2 weeks are given to all the ARCs for doing their due diligence, and I believe the 2 weeks are very well. Now, the ARC can also not do related party transactions. ARC cannot acquire from their connected lenders. ARC cannot acquire from their connected lenders. Like if I said that the Phoenix ARC is promoted by Kotak Bank, so this Phoenix ARC cannot acquire assets from State Bank of India. And then the connected leaders is a basically connected lenders also. Like in case the ARC is floated by Kotak Bank, so that ARC, which is Phoenix ARC, will not have transactions with the connected lenders. So they cannot pool together that Kotak Bank and the ARC. They can both collectively can do the related party transactions. Sponsors are also called related party. Group companies are also called related parties. And then is the sale to other ARCs. ARC can sell to other ARCs, but it has to be only on cash basis. No security receipts are possible in case the asset is going to another ARC. So the prohibited purposes cannot be avoided resolution responsibility. So the sale of ARC, sale of debt, sale of an asset to another ARC should not have the objective that the first transferor ARC should not have been doing it because they want to avoid that responsibility of recovery from the associate concerns. While the ARCs are supposed to acquire, the ARC can acquire fund-based assets, non-fund-based assets, and special mention assets. Fund-based assets, any kind of loan, limit, advances. Non-fund-based assets, guarantee, letter of credit, and other contingent liabilities. And a special mention account, like in the case the account is presently under SMA, SMA1, SMA2. So those categories of the borrowers can also become eligible for the kind of taking over the assets. So for taking over the assets, even SMA is allowed. Then like commitment and valuation. So this is where the contingent liabilities, valuation uniformity, pricing payment, this is all mentioned in the RBI directions only to provide some guidance to the ARCs regarding the acquisition process, regarding the due diligence, regarding valuation, regarding the commitment towards contingent liabilities, and regarding the pricing and the payment transparency. So these guidelines that we have till this. So from next episode, we will be dealing with the resolution or recovery process or restructuring process as per the master guidelines. So Ankit, we can take some of the questions now, if possible.
So we have a few questions. Let me start. So Jacob Matthew saying, aren't ARCs not able to acquire NPAs? If so, how can they acquire SMAs? No, ARCs, yeah.
Yes.
ARCs can acquire.
ARCs basically can acquire. ARCs definitely are made to acquire NPAs only. Rather, SMA 0, SMA 1, and SMA 2 are additional assets that they can acquire over and above the NPAs.
Yes. Then we have another question which says, how ARCs work on valuation of assets? Is separate empanelment policy is there? So with respect to valuation of assets, we at AAA Valuation have been working on valuing assets for ARCs. So one first step is for the ARCs to get the valuation done at the time of acquisition of assets. So normally banks these days hold a kind of an auction for the asset pool that they're wanting the ARCs to, they're wanting to be assigned to ARCs. ARCs are given some information and maybe a week's time, 10 days time to decide on what is the value that they would want to bid for that asset pool. And the ARCs normally, based on that information which is given by the banks, get a valuation done from the valuers who are empaneled with them. Also, when the ARCs are trying to, of course, do any SARFAESI action, they would again want to get a valuation done from a valuer who can kind of give a report on for that purpose. So these are purposes for which ARCs do get the valuation done. At the same time, this is also an opportunity for the valuation of SRs which are available with banks. So SRs which are with banks on the other side of it are also required to be periodically valued. So these are the opportunities in the ARC ecosystem for valuers.
Good, good.
Then Vijay is asking that so this question that we answered is based on the regulations, Vijay. We can also share the specifications with you separately, but the regulations, RBI regulations, do talk about how ARCs can sell in this way, sell the assign the rights
Rather
to
acquire.
acquire. ARCs can assign, rather sell, not acquire, sell the rights to a non-NBFC or a non-ARC.
No, I'm saying once the ARC acquires a debt, thereafter the ARC cannot cannot sell it to any other person other than another ARC, and that has to be 100% cash. So there is one requirement. Once the ARC takes an assignment, after that, the ARC will have to complete the job. ARC can only sell it further to another ARC against 100% cash and without any SRs. And
We can,
the only purpose should be to redeem the SRs, and not to kind of let away the responsibility of recovery. The objective should be to sell because the SRs are supposed to be redeemed, and not to shirk away from the overall responsibility of recovery and restructuring. And this is what is mentioned in the regulation, master directions.
right. I think many more questions. We are short on time, so maybe we will have to take these offline.
Okay, maybe next time again. So the next episode will be on the amendments in the CIRP regulations. There are 2 amendments in the CIRP regulations and 1 amendment in the personal guarantors regulations. And we are expecting another regulation, which is a liquidation regulations. In case that also will be notified in this week, then the next episode, which is 165 episode, that will be only on the regulations. And then again, 166 will be on ARCs. So thank you very much.
Right. Thank you.
Thank you very much. It is our way of learning, as we always say. Thank you.